If you're watching this video right now, then you are probably tired of blowing Forex accounts. Well, as beginners getting started, it's normal for us to blow account. Like almost every single profitable trader you see out there today has actually blown accounts that they don't talk about or they don't just even record anymore. Like personally, even me myself speaking here, I've blown accounts before. That's why in this particular video, I want to share with you some particular tips that you can implement as a trader to prevent you from blowing more Forex account. Like it's really sad when you blow account, more especially when you fund probably the only fund on you and then you end up blowing it. That's why in this video, I'm going to share with you some common mistakes we traders make that we probably don't notice until it's too late and probably blown 3, 4, 5 accounts. So in today's video, I'm going to share with you these problems and how you can actually avoid them. So with that already said, if this is your first time here, kindly do the YouTube business by smashing on that subscribe button, like this video so that YouTube will share it to more people. So with that already said, let's get straight into today's video. So to help you avoid blowing up your account, the first thing I would advise to do is that avoid non-technical or structural pairs. So what do I mean by non-structural pairs? So there are a lot of market out there when it comes into trading that actually don't obey key levels in the market. Like no matter how you try doing, those particular pairs, they don't obey some key levels in the market. And I see that these pairs are the ones that actually attract a lot of beginners' attention because they heard that there's a quick cash to be made from those markets. So if you're a beginner getting started in trading, there are some pairs that you shouldn't try with, like market like gold, US 30, US 100. In fact, when you are new to trading in general, one thing I advise you to do as a beginner is that avoid indices, avoid metals and energies. The reason I'm advising you to avoid these ones at your first stage is that those particular markets move more with more fundamental details. So most people you see that trade those particular markets are highly into fundamental analytics, meaning they keep their eyes on news because market like gold, US 30, US 100 are mostly moved by what happens in the are mostly moved by news. And one thing I see is that a lot of beginners, once they get started with trading, they simply go on to YouTube or Google and search for most volatile pairs so that because they know that when there's more volatility, they are actually going to make more money from their trade. But in reality is that those highly volatile pairs will actually lead you to blow up your account before you even notice it. Like personally, I trade gold, but when I got started at first, I blew 2 accounts due to gold. Yes, I blew 2 accounts out of gold. When that was when I started off. But now I still trade gold. But one thing I realized is that after gold let me blow up my first 2 accounts, I had to slow down on my interest in the market. Though the market was highly profitable, as much as it gives you more profit, that's why you can also take back faster. So if you're a beginner out there who is getting started with trading, I advise you to avoid non-structural pairs, market that don't respect key levels, avoid them at your start. When you start trading probably for 6 months, 1 year and be able to find consistency in your profit, then you can go try your hand on those particular markets because those markets are highly volatile and they can wipe out your account immediately. So that is the first tip I have for you, avoid non-structural pairs. So if you want to get started as trading and really want to make money, I advise you to go to currency pairs. Now when going to currency pairs, avoid Euro USD. As a beginner, avoid Euro USD. The reason I advise to avoid that market is that market is also under highly manipulated market. Like Euro USD, gold, US 30, US 100, most of those markets are highly manipulated. That's why I see that there's high profit opportunity for people who are already experienced in the industry. So the first advice I have for you is that avoid non-structural pairs. After those indices, stock, and the rest, also avoid Euro USD if you are getting started. This doesn't mean you can't trade it. You can go trade it if you see that it's working for you. But if you realize that it's among those things giving you trouble, whenever you set it up, it doesn't go your way, then I advise you to avoid that particular market as well. So that is the first tip I have for you here. Avoid highly volatile markets when getting started. Use the slower pairs to help master your strategy before you go try your hands on those high markets. The second tip I have for you is simply avoid taking random trades. Yes, as we all know, when you do something randomly, you don't expect any solid result because you usually get a random result as well. And this one thing that personally actually helped me blow most of my account. Like, I'll be honest with you. Like, if there's one thing that I've seen that I've helped, that let me blow and help other new beginners. Yeah, I'll use the word help other new beginners blow account. Is actually taking random trade. Like, trader, you and I know that this trade doesn't play according to your setup. The market isn't in a good condition for you to take the trade. But still, you find your way into that market, take that random trade that doesn't comply by your trading strategy, and then you end up losing your money, probably even over risking in most cases. Because one thing I realized is that a trader who follows the setup, even when he makes losses, you still have a higher probability of regaining those losses than a trader who goes against his strategy to take on random trades. Like, earlier today, so this actually 13th of June, 13th June. Personally, I did a setup on a USD JPY. So after doing the setup, and I realized that my entry time was close to when the PPI news will be released. So for my own security reasons, I didn't get into the market because my trading strategy doesn't allow me hold trade into high impact news. So since there's a high impact news coming on, I had to stay off and then wait for the market to actually finish up processing every single information that is coming out from the news before I get into the market, and I still made a decent profit at the end of the day. So one thing I always advise you to do is that always follow your trading strategy. No matter the great opportunity you see, if you see that it's not complying with your trading strategy, just let it go. Avoid that random trade, and then have days whereby you know that okay, these are the days you want to trade. These days you are not willing to trade, and then these sort of opportunities are not things you trade. Like when you come over to me, there are a lot of currency pairs out there, but I don't trade all of them because some of them I see them as random pairs that don't correlate with me. So I don't trade them. Even when I do setup, I can do setup and then see that the market is going to my direction. Provided that the market hasn't come back to retest, maybe I'm waiting for the market to come and retest an order block or a supply level, a fair value gap, or any key level or a trend line in the market. If I'm waiting for the market to come back to come retest these zones and it hasn't done that, and I said the market is already going to my direction, I still won't take it. Because one thing I've realized is that those sort of markets you hop in are the ones that actually help you blow your account in most cases. So the second tip I have for you here is simply try as much as possible to avoid taking random trade. Have the rules of your setup, set those rules and follow them whenever you are setting up your trade. If any of the trade doesn't go according to those rules, no matter how good or juicy the position looks like, don't get in, let it go. The point number 3 is simply avoid trading random pairs. Now this one thing a lot of people overlook when it comes to trading. A lot of us when we get started with trading, we'll go on and trade the most popular pair that a lot of people have actually let us know about, like Euro USD, GBP JPY, GBP NZD, and those ones, without having a clear understanding on how those particular pairs move in the market. And this one mistake I say I've made over for the past few years of me trading that I recently realized just a year ago. So when I realized that like when I take a new pair to trade, apply my normal strategy, it's not that it doesn't work, it works out, but then it gives me a funny movement from the other pairs that I'm used to, like GBP JPY, that is my favorite. Like one thing I realized is that every single pair has a unique way they move. Now for you, a trader who is new to trading these pairs, you might find it difficult actually trying to understand their movement. Like for me, when I got started at first, I started trading NZD pairs, but I wasn't understanding NZD movement. Like market will go up, but suddenly you see a drawback, and then whenever it comes into that drawback, as a beginner getting started some time ago, what I'll simply do is that I'll simply just close off my trade, and then if there's a minor loss, I just take the loss and I leave the market. And I started blaming it. So one day I was like, okay, instead of always blaming these pairs for doing this sort of funny movement and not moving like GBP JPY, why don't I try backtesting this pair and then looking at the time of the day that it moves well, and also try to understand how it creates its own structures. And so for that reason, when from that day on, whenever I want to trade any new pair, like I'll first of all go and backtest this pair. Like for a whole week, I can go a whole week and backtest this particular pair. Once I backtest it, when I'm backtesting it, I'm identifying the flaws of my strategy in that market. And then once I'm identifying it, I'm looking for a way to actually rectify it to make sure that it matches with the market movement system. Because every single pair has their out there have different ways in which they move. Like if you are trading NZD pair, you know that NZD pairs have the funniest drawback in the market. Like they can go saute, they'll surely come back to come and create a swing point before they will continue again. Unlike other pairs like USD JPY, they can just pump upward. Like GBP JPY can just pump upward without any structure. Euro USD can just go to any direction they want without any structure. But when it comes over to NZD and AUD pairs, they are totally different. Like if you are trading AUD card, you know that that market is the general headquarters of wicks and Euro, AUD Euro, and then all this AUD card. You know that they are the kings of wicks. So when you come over to trading, I advise you that before you take any pair to trade, in order to avoid blowing your account, backtest that pair to make sure that you have a clear understanding on how that pair moves, so that you don't get to take unnecessary losses just because the market is doing the usual thing he or she normally does. I don't know if it's male or female. So that is the point number 3 here. Simply don't trade random pairs, backtest them, see how they move before you start trading them. The point number 4 is simply examine your strategy. So what do I mean by examine your strategy? So like you might be trading something totally that is not resonating with the market. Like personally, when I got started at first, the way I was trading the forex market, like I can't even compare it to the way I'm trading it now, because whenever I reflect on how I was trading the market before today, everything literally sounds funny. Why? Because back then I thought I had a strategy by just watching some YouTube video and then learning only one technique. Was it just the shooting star abi what? So wherever I see that shooting star, like I'll be like, I'll just get in line. And I keep making so many losses, and I was like, why? But this same thing worked on this YouTube channel. And one thing we don't realize is that behind every single concept that someone teaches you, there is something behind it you are not aware of. Like, for example, if I should teach you about order blocks now. Okay, now I told you that whenever the market puts into an order block, you should be looking for, if it puts into the lower order block, you should be looking for a buy. If you put into the upper order block, you should be looking for a sell. Now, one thing you might not know is that that order block might be just a, like, after teaching you, using one as an example for you, you might go and try it in your real account and realize that it's not working. But one thing you fail to understand is that that particular order block I used for the tutorial, I had a different concept behind it, not just an order block. Probably that order block, I spot it in a trend line that came to retest, and then you might go and find your own order block in a ranging market that might lead to breakout, and then you lose your trade or something. So when it comes over to trading in general, your strategy plays an important role. So if you see that you've tried so many things and realize that still nothing is working, I think you should consider refining your strategy as well. It could be the main problem behind it. I'm not saying some strategy doesn't work. Like every single strategy out there works. Like we have ICT traders, smart money traders, price action traders, which is where I belong. I belong to price action and SMC. I do both of them. Like I miss them to actually get my trading strategy and get everything going. Since it's profitable for me, I keep up with it. So one thing I always tell you is that if you think that you've done every single thing possible, but then you keep realizing that you are still more of the losing zone, then I think your strategy has a flaw that you haven't realized yet. Go back to that channel where you learned it. See if they have a playlist in that particular topic. If your strategy you learn is first under price action, look for a full price action course to go get a back end information about that your strategy. And then if that strategy falls under smart money, do the same thing. If it falls under ICT, do the same thing. Do background research of that particular technique you are trading so that you know the best time to get into the market and when not to get into the market, because every single structure happens in everywhere. Like the way I get order blocks and fair value gaps in a trending market, you can also get order blocks and fair value gaps in a ranging market. And the probability of a fair value gap or an order block of working out in a ranging market is as low as 0.5%, but the probability of it working and being efficient in a trending market is over 80%. So that is simply the difference I have for you here. So that's simply it about the point number 4 here. Simply try examining your strategy to understand if that's not where you are getting problems from. So my final advice for you to help you prevent blowing another account is simply lower your risk. Like lower the amount of money you are risking in a trade. So this one thing, like almost every single person that have actually worked with me before, I always tell them that when you are starting off as a trader, even if your account is up to $1,000, like try as much as possible to use a decent lower risk level, like a lower lot size. The purpose of me telling them to do this is not that I don't want them to make money. Like we all are trading so that we can make money. Like personally, I don't do any other job apart from content creation and trading. So there's no way I'm going to tell someone to use lower position size just because I don't want the person to make money fast. No, the reason I always advise a lot of people to start with lower position size is that when you use a lower position size as a beginner getting started, your losses doesn't affect you because probably you're losing $5, $10, $3 within those areas. So if you're using those ones for your stop loss, it's pretty much okay. You are not really moved that much. But then when you start as a beginner and then started losing $50, $100, depending on your financial ability, like you start to feel that fear in you. And once you have this fear in you as a trader, you always have this thought of revenge trading, and that thought of revenge trading will lead you to blow up more accounts than any other thing. So that's simply all I have for you in this video. Simply apply these 5 things to that your account and avoid blowing more account. I'm sharing these things with you because most of these things are things that have helped me blow accounts, and also some of them are things that I've actually learned from others who also blow their own accounts as well. So in this industry, we keep on learning every single day. Like I'm barely 3 or 4 years in the industry, and there are other people that has been in it for a long time. So with that already said, hope you find this video helpful. If yes, do me one favor by smashing on that subscribe button, like this video, and also tell me what you feel down in the comment section. So with that already said, have a nice day. Bye.